But the trader who buys and sells, then buys and sells, then buys and sells, actually makes more than the total individual who bought and did nothing else but sell at the end. All right. It's in some cases, you can come as close to a 50% extra returns. Now, I want you to specifically note in the middle of the chart, you'll see a period where the 20-period moving average and the 200-period moving average are actually relatively close together, if not entirely close together. Look, 20 and 200. That's what we call a narrow state. The two moving averages are together. Now look to the right-hand side of the chart and the left-hand side of the chart. You'll see that you have Apple in what I call a wide state or a wider state. So what the markets do primarily, all markets do, is they vacillate between a narrow state where the moving averages are close together and a wide state where the moving averages spread apart. Now this spread apart wide state can be to the upside or the downside. So in this case, you see Apple moving to the upside from its narrow state into a wider state. All right, you see from the wider state back in February moving back down into a narrow state. And if you look at the entire singular cycle that repeats itself over and over and over again in all markets, it's this: narrow to wide, narrow to wide, narrow to wide. And it's very important for you to know what state of the stock or the individual item that you're trading is currently in, because stocks have different potential from narrow states than they do from wide states. Narrow states are more ideal for creating initial entries. All right. Wide states are more ideal for taking profits or selling, or even sometimes for the slightly more aggressive, looking for shorting opportunities. All right. So I want you to remember this concept: two moving averages together, narrow states. Two moving averages wide apart, wide state. Narrow state, better for initiating new positions. Wide state, better for taking profits or even sometimes looking for short-term shorting opportunities. Now, there's something else I want to explain to you regarding the concept of space, because this is no space, wide space in terms of the moving averages. Take a look at the blue 20-period moving average. There's a minor space element I need you to understand as well. That is that stocks can get away from their 20-period moving average. They can. They just can't stay away from their 20-period moving average. You see, once again, stocks can get away from their 20-period moving average. Oh, it's very possible. But they just can't stay permanently away from their 20-period moving average. They must narrow the gap at some point. A stock can get away, but it can't stay away. It can get away, but it can't stay away. This is a very important concept, because when you combine the minor space concept with the macro space concept, you can really dial in your timing very well. So when I told you that, for instance, when I told you that when your two moving averages are relatively close together, this is a very good initiation point to initiate a brand new play, to go in more aggressively as your first foot in the water, for lack of a better term. And so let's say you did it on this very, very solid, beautiful bar right off of the 20, the 200, and the 20-period moving average. Boom! With the two moving averages relatively close together. Now, you wouldn't want to initiate your position here because you are away from the 20-period moving average. If you missed this initial opportunity, it would be better to wait for the stock to pull back toward its 20-period moving average, and then perhaps get in above a red bar. Boom. You wouldn't want to initiate your position here because there's been a thorough move away from the 20-period moving moving average. You'd likely be best off waiting for a pullback to narrow the space and get in closer to your 20-period moving average. You certainly wouldn't want, this is 3 days ago, right? You certainly wouldn't want to have initiated a position there. You are too far away from your 20-period moving average. And this is very, very prone for a pullback toward its 20-period moving average. So take a look once again. Look at the peaks away and look at the troughs, the mini troughs near. And you'll see the cycle repeat itself. Boom, boom, boom. If you can play this cycle correctly, getting in near the bottom and getting out or taking some, lightening the load somewhere away, you can actually outperform the buyer and holder who does none of this. So the buyer and holder, nothing wrong with that, buys, and let's say they even sell here at the very top, right? They probably wouldn't, but let's say they did. But the person, the trader who buys and sells, then buys and sells, then buys and sells, actually makes more than the total individual who bought and did nothing else but sell at the end. All right. It's, in some cases, you can come as close to a 50% extra returns by timing with the space concept more appropriately, lightening up away, getting back in more aggressively near, lightening up away, getting back in. Let's take a look at a couple of additional examples here. All right. Here's Baba. Now look at your points. Look at the narrow state. Okay. You're dealing with your narrow state here. Two moving averages together. Look at your move away from the 20 and look at your pullback. Look at your move away from the 20 and look at your pullback. Look at your move away from the 20 and now we're experiencing the pullback. Very clearly, this is something that a 12-year-old should be able to understand. If your trading approach cannot be understood by a 12-year-old, it's too complicated because this game is not as complex as it feels. Okay? Away from the 20, away from the 20, away from the 20. Stocks can get away, they just can't stay away. They can get away, they can't stay away. And it's the snapback that you never want to be caught in. You never want to be caught buying here. I don't care what the news is, not if it's away. So your first check should be, let me check to see what part of this cycle am I in? Am I here in the cycle, or am I here in the cycle, or am I here in the cycle? All right. Am I here in the cycle? Am I here in the cycle? Or am I here in the cycle? This is the cycle, and it repeats itself. This is the cycle, and it repeats itself. This is the cycle, and it repeats itself. At the end of the day, the market is trapped on rails. Its rails look exactly like this, traders, over and over and over again. What makes it a little bit more complex is that sometimes it's like that, sometimes it's like that, sometimes it's even, sometimes the right leg is shorter than the left one, and sometimes the left one is shorter than the right one, but they're all the same cycle. And you can see it very clearly on this daily chart of Baba. Cycle, cycle, cycle. All right. You never want to be caught entering your play away from the key main 20-period moving average. Okay. Let's continue onward. Here is Microsoft. Now, Microsoft, I want you to take a note here with Microsoft, how it doesn't really get significantly away. This is what I call more of your railroad track rally, where your stock is actually like railroad tracks parallel. See, parallel can go on for quite some time. It's only here that it got a little bit ahead of itself and is now pulling away. But for a period of time, except maybe here, it was really railroad tracking. We don't want to sell railroad tracks. When your stock is traveling like a railroad track with the 20-period moving average, sit back, have a Coke, and smile. This can go on for a long time. But if there's a sudden surge away that breaks that railroad track, that's when you want to lighten up on the play. If there is a sudden surge that breaks that railroad track, like move up, that's when you want to start lightening up on your load and looking to reposition when the other part of the cycle materializes or finishes. Okay. Here is another one. PayPal is more like railroad tracks, not to, look, there was no surge away. You see, railroad tracks, this can go on for a while. Railroad tracks, and this is why this decline is not even that severe yet, because it's not coming from that elevated away position. Okay, good to know these differences. Okay, here is QCOM. Notice how it's railroad tracking at first. All right, railroad tracking at first, pausing, but then it blasts away and it's got to come in hard after that. You see, it's basic physics. You throw a ball up in the air away from you, and at a certain point, it's got to come back down toward you. It doesn't go up forever. All right, so the only thing that's enduring is that railroad track thing. But the sudden violent move away, that's not enduring most of the time. Nothing's 100% of the time, as we know, but most of the time. All right, here's Twitter. Look at the moments away. This should become very basic to you now. Away, we pull back in. Away, we pull back in. Away, we pull back in. And look at that cycle repeating itself over and over and over again. This can help you with your timing. You're coming into the cycle here in the cycle. Let me clear this again so that you get this clear. You're coming into the cycle here. You're coming out of the cycle here. Out, in, okay? Out, in, out, in the cycle somewhere here. Out, in, not, you don't have to come out of everything, but out, and if there's a turn here, in, okay? This can dramatically help you with your trading. Some people say, Oliver, it can't be that simple. It really is that simple. Like, the market doesn't have complexity. We bring the complexity. We bring the confusion. We bring the difficulty with our lack of discipline, with our inconsistency, with our inability to follow a plan, a systematic approach to trading, to your buys and sells that you apply across the board evenly to every single play. We bring a random style of market play, largely driven by fear and greed, no systematic approach, and no discipline on top of that. Of course, the game is difficult, extra difficult, when that's the type of baggage you're bringing to the operation, right? But basically, we're dealing with a mechanism that has 3 directions, 3 motions, up, down, sideways. That's it. That's not a complex mechanism. The human body is a complex mechanism with billions of things firing off at the same time. The market is rudimentary. It's basic, up, down, sideways, up, down, sideways. And for the most part, it has one cycle, the cycle we're talking about, the movement away from your moving averages. On JD, the movement away and the comeback in, away and the comeback in. These are charts from today. I'm not making these things up. You come out of the cycle here, or at least in part, you come back into the cycle here. you get out of the cycle here, you come back into the cycle here, you get out of the cycle here, and repeat, 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 repeat. All right, the market is a repeating mechanism, so therefore you have to be a repeating mechanism to benefit from the market. Okay, take a look at JPM, very interesting. Look at the movement away. Look at your movement away from the 20-period moving average. Look at that distance, bumping its head up against the 200. We fall all the way back to the 20. Okay, there's that cycle again. It's over and over and over and over again, guys. There is only one cycle. Citibank's going to be the same as JP. They're both banks. They're going to trade very similarly. Away, boom, you come back toward. Powerful. Adding the macro space. What's the macro space? Do you remember the macro space concept? When they're both together, this is when you get powerful moves up or down, right? But you come out of this narrow state either to the upside powerfully or the downside powerfully. Of course, we came to the downside powerfully. Now, once you're wide, you're looking for a reversal back to narrow, all right? And then either wide again this way or wide again that way. Repeat, repeat, repeat. Now, that's the macro concept of space when the two moving averages are close or wide. But also the micro concept of space is when your stock gets away from that 20, you're looking for the 20 to pull the stock back in. It's almost like a dog that gets a little too far ahead of its leash, and then the owner sort of tugs the leash and tugs the dog back close to him or her, right? Same concept, all right? Powerful, powerful. Away, and we come back in. Away from the 20, and we come back in, all right? Away from the 20, we attempt to come back in, and sometimes it takes 2 attempts, all right? But you don't want to get caught here, away. So this should help you with your timing, knowing where you are in the cycle based on the concepts of space. I'll show you one more thing before I close out this brief but very, very powerful talk. Now look at the concept of space. See where the two were narrow? We came into this narrow space with the two moving averages, a powerful move to bring the moving averages far apart, right? Now we've got space. We have to look now for the move from narrow to wide, back to narrow again, all right? So now we're going from the wide space, buying here, but we're also now going to incorporate the minor concept of space while we go for a long-term play all the way back to narrow, right? So check this out. What happens next? Boom, there we go. So here was the buy, all right? There's the buy. Look at the move away from the 20. What do you think you do here? Take some or all off, your choice. And you look for pull back toward the 20 again. And you do this as you're looking for the move back to a global or macro narrow state. So we play the macro concept to find the entry. And then during the entire play, bring that minor concept of space into play in terms of when to add some, when to take some off, when to add some, when to take some off, just like Carnival Cruise Lines here. So guys, that is a powerful concept. Write it down. I want you to, if you have an opportunity, I want you to watch this over and over and over again so that it becomes a permanent foundation of how you approach the markets, how you see the markets, and hopefully how you play the markets as well.